Alright, so in the last couple sessions, we've talked about what position sizing is and a great model to use to correctly size your trading positions. Now we have to answer that question, what percent risk should I use in this percent risk model? If you remember, we were using like 1.5% or 2%, but in reality, how do you know what you should use in your own trading? And that is what this session is about. Now we're getting into the real meat, the stuff that really determines whether or not you will survive as a trader, whether or not you will last long enough to develop a positive expectancy strategy, to build the skills to do that. And then once you have that, whether you will keep surviving and keep thriving as a trader for many years. This is the difference between those that make it over the long term and those that blow up and burn out. Alright, so let's ask the question, what is your number one goal as a trader? What is the most important thing you have to focus on? Try to think about that right now. What would you say that is, the most important thing? Well, the most important thing is staying in the game, right? Your number one goal in trading is capital protection. You need to stay in the game. If you don't protect your capital and you don't make that your number one priority, the markets will take your money. If you think you can figure out the markets, if you think you can outsmart them, if you think you can just focus on making as much money as possible without focusing primarily on capital protection, you are going to lose your money. I mean, there's no other way for me to say that but that. Now, I know some people will still not listen, and I've had people in the past where I've advised them exactly how they should do it, and they didn't take my advice, and now they're out of the game. They've lost all their money. So do yourself a favor and focus on this the most. All right? Now, how do you actually lose your money, right? In trading, what are the ways you can really lose a lot of money? And once you know those, then you can know how to avoid them to protect your capital. So let's take a look at that. Well, there are basically two major paths to losing your capital, right? There's an infinite ways you can lose, but there's two, you can group them under two major paths. The first one is that you go through a losing stretch, period of losing trades like we had looked at in the last several sessions, one losing trade after another, while risking too much of your account per trade, i.e. this is incorrect position sizing. You risk too high of a percentage of your account per trade, let's assume 10% per trade of your account, and you go through 8, 9, 10 losing trades and you've just lost all your money. That's one way. The other way is that you don't cut your losses quickly when you have a losing trade on, and you end up with losers that are too large. And this is incorrect trade management. So let's say you just entered long into a position, right? You just bought, and the market goes against you. You just happen to be wrong this time. And instead of taking your loss quickly when it hits your stop loss, either you remove your stop loss or you trade without one to begin with, and you just let it keep going down. And you start playing the market based on hope. Oh, it'll come back. I don't want to take a loss. It'll come back. And you end up with one loss that should have been, let's say, a 1 or 2% loss, but it ended up being a 10-15% loss because you just let it get bigger and bigger and bigger. And it won't take long if you have just a few of these before you've blown your whole account. So those are the two major ways. All right. Now in this session, we're going to focus on the first thing, which is the incorrect position sizing. We'll get to the second aspect in a later session. And so to focus on the first aspect, the incorrect position sizing, we got to define a few terms. So let's go ahead and do that. All right. What you see here in front of you on the screen is not a stock chart or a futures chart. It's a depiction of a hypothetical equity curve, i.e. the money in your account. All right. So first we start, let's say, at a low level and we're making money, and we hit a point that's called an equity peak. That means that's the highest level your account has reached after it's been accumulating profits up to that point in time. Then let's say you hit a stretch of losses, which is normal, and you keep losing until you hit an equity trough. Now the distance between the equity peak and the equity trough is called the drawdown. Okay, so let's assume we had started at a $50,000 account. We made quite a bit of money. We reached $100,000. That was our equity peak. Then we had a drawdown of $20,000. Okay, from $100,000 peak, $20,000 drawdown. So we hit an equity trough of $80,000, right? And then we started making money again, and we went over 100,000 and we went up to 120, which now gets labeled as a new equity peak. And then this whole cycle repeats itself. We'll have losses again, which will be a drawdown, and then new peaks. So the equity curve of a profitable, consistently profitable trader will look like this. It'll be a rising curve that has peaks and troughs. Now it won't be exactly like this. It'll be jagged. It'll have many little losses, many small wins, and it'll look more like a stock chart or a futures chart. It'll be swing highs and swing lows, swing highs and swing lows. It'll move in waves, right? But I just want to clarify these terms, because having a correct understanding of these terms will be key to sizing your positions correctly and protecting your capital, right? So now let's think about this. What is an acceptable drawdown if your goal is to protect your capital? How much is normal and how much is too much of a drawdown? Well, this really depends on two things. It depends on math and it depends on your psychology, your personal psychology. And to show you what I mean by this, let's take a look at an interesting table. Alright, so this table has two columns. In the first column, it shows the drawdown you're experiencing, the percent. You know, if you have a $100,000 account and you have a 10% drawdown, that means you just lost 10,000. If you have a 50% drawdown, you just lost 50,000, and so on. So that's the left hand. The right hand is the interesting part. It shows you what return you need to make to recover from this drawdown. Okay? So let's take a look at this. If you have a 10% drawdown, and let's use the example of a $100,000 account. Okay? If you have a 10% drawdown, you just lost $10,000. So now your account is at $90,000. Now to get back to break even, you have to make $10,000. You lost 10, you need to make back the 10. But now making $10,000 is not a 10% return, it's an 11.1% return, because you need to make it on a $90,000 account. You no longer have a $100,000 account. So 10,000 divided by 90,000 is actually 11.1%. So okay, that doesn't seem too big of a deal. Now though, when you go to 25% drawdown, so if your account goes from 100 grand to 75, you need to make 25 back up to get to 100, but now 25,000 on a $75,000 account is 33% return. Okay? And it really gets interesting when you hit a 50% drawdown. So you've lost half your account, okay, no big deal, but now to make that back up, you need to make $50,000 on a $50,000 account. You need to make 100% return. You need to double your money just to get back to break even. And of course, as we look at those, it gets much more interesting. At a 75% drawdown, you have to make 300% return. And if you have a 90% drawdown, even though you haven't lost all your money, right, you still have money in your account, you need to produce a 900% return just to make your money back. And I don't have to tell you that making a 900% return is no easy feat at all. And so focus on this table a bit. There's two things at play here. One is just the simple math of it. Okay. But two, something that is not shown in this table is the psychology of it. Right? I want you to put yourself in that position. Assume you're trading and you've just lost half of all your money in the account. How do you think you're going to feel at that point? Let alone the fact that you need now 100% return just to get back to break even. But how do you think you're going to feel emotionally after having watched yourself lose half your money? You think you're going to be in a proper state of mind to continue trading with discipline? That's very doubtful. what's likely going to end up happening now is that you are going to get emotional and you are going to start making mistakes. You're going to start being afraid to lose more and not taking good trades. You're going to start not accepting losses, which is the second path, and letting your losses run based on hope. You're going to start sizing your positions even higher to try to make back the money quickly, and all these things are just going to kill you, and you're going to end up losing all your money very, very quickly. So while it seems that a 50% drawdown might be normal and, oh, you still haven't lost it all, in reality, you never want to get that far. Because other than the math of needing to make a 100% return to make it up, just the psychological toll it takes almost guarantees that you won't be able to do it. So, given that, what is an acceptable drawdown level? What is a level that is considered a normal drawdown and which still allows you to meet the goal of protecting your capital? Well, really, it ends up having to do with your own psychology. Each person is different. For some people, 10% may be as big of a drawdown as they want in their account. Others can handle 25% drawdown and without feeling too scared and still trade with discipline. So it really depends on you. But what this table shows is that no matter who you are, once you start getting into those levels 40, 50%, very few can handle that kind of pressure. So the recommendation is no matter who you are, 25, 30% should probably be the upper limit of what you accept as a normal drawdown. And it can be much lower based on your psychology. But let's actually jump into another spreadsheet and take a look at the actual way it works, what the actual numbers are for different risk points, and what the risk of ruin, i.e. of losing your whole account, is under different scenarios. I think it'll be very instructional and help you understand this at a deeper level. So we'll get deep into that in the following session.